So let's talk about credit assessments and what the heck do I mean by it's more than the math. Well, first of all, you have to look at your customer and assess your customer. And that certainly does take some mathematics, financial statement analysis, ratios, trends, benchmarking, understanding each line item on the balance sheet and the P&L and the cash flow. That is definitely important. So financial analysis is certainly a component of assessing the risk of a customer. The 5 C's of credit, which we're going to go into in a bit, is a way of looking at various characteristics about this company and assessing their creditworthiness. You have to look at the buyer's history. Did they have a history of prompt payment to their trade creditors and their banks? Are they past due? Have they been referred to collection agencies in the past? You're looking at public records. Is there a history of bankruptcy? Is there a history of a lot of liens against the business? You can see a lot through the public records. You're looking at trends. Is the company in an upward projectile period over period? Are they flat or are they going down? And how does that compare with other companies that are in their industry? You have to understand the buyer's industry. What are certain characteristics about the industry in its entirety? Is it a growing industry? Is it a declining industry? Is it a highly competitive industry? Is it an industry very dependent on seasonality? Is it an industry very dependent on a certain supply chain that may be at risk? So you have to understand all of these factors to really do a good credit assessment. Then you need to understand your company's internal concerns. You need to understand what the profit objectives are for your company. You have to understand how your company's competitive situation is and how you need to address a credit approval based on the competitive pressures that your company faces. You need to understand the risk tolerance of your company, and this will vary. Some companies have a very high risk tolerance. Maybe they're highly profitable. Maybe they're a very dominant supplier, and they can take more risk because they know that their customers have little choice. So what is the risk tolerance? If you're a very minimal profit, the risk tolerance may be very low. If you're leveraged, highly leveraged company, maybe your risk tolerance is pretty low. You have to understand if your company is able to get secured collateral and really protect themselves. You need to understand what are the overall financial objectives of your company and how does this potential customer fit into that? And what are the product strategies? Is this company that you're assessing buying a product that is end of life or a product that is new and there's a lot of demand for, and that could shade your opinion as well. So putting it in the context of your customer risk assessment and what are the internal concerns and drivers within your own company. Those are all considerations in a thorough credit analysis.